Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. It's so great to have you all joining us today. We have another very special edition of ETF Market Insights with a special guest, Mr. Larry Berman. But before we get started, just as a reminder, everyone joining us, today we're not providing any recommendations and we will not be providing any advice. These sessions are simply about educating direct investors and DIY investors and providing information on the markets and on ETFs. Now, speaking of ETFs, one of the most famous ETF investors in Canada, I would say, is Larry Berman, and I'm so excited to have him join us today. Larry and I have worked together for a while. Larry's been a partner of BMO ETFs for over a decade. It's great to have you, Larry.
Well, it's great to be here, and if I can just do a very quick sidebar, I say stuff publicly on TV, and people take that as advice, and it's intended to be educational, it's intended to be informative, but I once said the market was going to correct 5 or 10%. This is going back maybe a decade ago, and the market corrected 4.9%. Right. And this, anyways, I happen to be sitting next to this guy on an airplane, and he just chirped my ear off for 4 hours because, you know, he sold his entire portfolio out because of something I said on TV. And it's just, you just can't do that. Right. You gotta take it as educational understanding. And if I say today that I'm nervous about markets, please don't sell everything.
That's exactly right. We don't have crystal balls, right? We wish we did, but we don't. But we do the best we can with the information that we have, and we want to share.
Well, so Danielle, I actually do have a crystal ball, but it's foggy sometimes.
Okay, yours is a little more clear than mine. Okay, as we get started, so reminder, everyone out there, we have a YouTube channel. So if you're joining us from GoToWebinar, that's great. But we're also broadcasting live on YouTube. Follow us, click subscribe. If you turn your notifications on, you will be notified every Friday when we do live events. And Larry, I will mention before we jump in, you also have a YouTube channel as well. You have your Berman's Market Call and Investor's Guide to Thriving up there. So lots of information and education for investors to check out on YouTube. Now, Larry, I call you the OG, like the original gangster of ETF investing, especially in Canada, because you adopted ETFs well before many other active managers. A lot of active managers still doing the stock picking thing, and you were looking to ETFs. What brought you and your career to choosing this vehicle to use as you're actively managing portfolios?
Well, it starts very early in my career when I was just a junior person working at Burns Fry, which ultimately now it rolled up into BMO at Nesbitt Burns. But I was a junior analyst, and they had just launched the index participation units, the tips and the hips for the TSX tracking. And I thought, you know, as someone who looked at charts and you want the exposure or don't you? Right? So I didn't have to worry about which 35 stocks to buy. It was just, you know, now it's the TSX 60, but back then it was 35. And it's just, do I want to be in the market or don't I? And I really liked that, and it appealed to me in a big way. And so from the very early days, there was a Nikkei warrant tracking that tracked the Japanese market as we were going through the first Gulf War. And that was actually very interesting to trade. So, you know, I got involved in index participation units from the very early stages of my career, and as ETFs started to grow and proliferate, they just become great vehicles to get market exposures in a very efficient way.
Thanks, Larry. I couldn't say it better myself. ETFs providing that diversity, that market liquidity, getting in and out of exposure so easily, cost efficiently. So many benefits to using ETFs. Now, let's chat a little bit about the market environment that we're in. So a lot of investors and a lot of our audience members today have never before faced rapidly rising rates, never before faced a lot of the inflation and volatility that we're seeing. So let's start with rising rates here. You've been investing for a really long time, and you might have been, seen these types of market dynamics before. So how are you approaching markets right now in this rising rate environment?
Well, so here's the thing. I've been saying for years that the 60-40 portfolio is broken. The traditional balanced safety because of interest rates going so low, duration or the risk of fixed income outside of credit is the highest it's ever been. And in the idea of risk parity and balanced and Nobel Prize winning work of the early 1990s on efficient portfolios and diversification and higher return with lower risk. You just can't get it anymore with traditional fixed income. And I know BMO is one of the world leaders in fixed income ETFs, and they're still great for getting exposure, but it's the asset class itself where the challenge is. And so, ETFs now have come out with institutional type strategies where you can put volatility buffers. So, for example, a company in the US called Innovator ETFs came out a number of years ago and created what they call these buffer series. So they buy some put protection, they pay for it with a covered call. And what I'm comparing here is the January series of the 15% buffer compared to the BMO balanced 60-40 and conservative 40-60 global portfolios. And what you can see is through COVID and the worst, traumatic shock to the world shutting down for a couple of months, that the all equity S&P 500 portfolio behaved like a balanced portfolio from a volatility perspective. And so ETFs have become a vehicle to now deliver quite sophisticated strategies. And webinars like this, Danielle, and the education that they offer can open the eyes of the individual investors and teach them about these things, how to use them in portfolios compared to, like say, the generic 60-40. Nothing wrong with it, except in a rising rate environment this year in particular, fixed income hasn't done the job. And I would argue maybe for the next couple of years, it's going to be a challenge in the fixed income space. So you need to look at alternatives. And ETFs now offer some of these very sophisticated strategies.
Yeah, we're going to get to some of those later on in the show, but really good points there, Larry. And just as a reminder too, some investors, you might need fixed income in your portfolio to have that more stability. We've talked in other shows about things you can do in the fixed income space, like shortening your duration or trying to reduce that volatility in a rising rate environment. But Larry brings up a good point. If you do your research, there are a lot of products out there that can provide strategies to help weather the volatility that aren't fixed income options. Now, inflation, this has been top of mind. We see the numbers roll out every month. They're not cooling off. Larry, what are your thoughts on managing portfolios in this kind of environment?
Yeah, well, I would argue that we've hit peak inflation on a mathematical basis. When we get the data over the next few months, we probably will have seen that April, May, June is peak inflation. The numbers will come down. Here's the thing though, when you go back far enough, that range over the past decade or so has been the 1% to 2% range. And the Fed always talks about that too. And very likely, at least for the next several years, as there's less globalization, more onshoring, wages are going up. Apple talked about this week, raising wages, and you're hearing that, from multiple big corporations that they want to pay the average worker more. And so that's all actually good. It's not great for profit margins, but it's good for, national income, and it's good for inequality issues and so forth. So I think that means, though, inflation is stickier, and the base rate is not going to go back to 1 to 2% anytime soon. It will eventually, but probably is in the 3 to 4% range for a while. So that just means nominal fixed income will remain a challenge, for at least a couple more years, I think.
Yeah, thanks, Larry. And what I pulled here on the screen, I thought this was interesting, to your point about so many factors playing into the inflation equation. This is from Stats Canada, just showing CPI with gasoline included and without gasoline included. And you can see, although the gas price is impacting inflation, there's still a lot of upward pressure on that inflation number coming from all these other variables that don't seem to be going anywhere anytime soon. Larry, one of my favorite things to talk to you about over the years is valuations and market valuations. And I know for the last several years, you've been saying, markets are completely overvalued. You haven't been very bullish on high tech or growth stocks. So now we're seeing this big reversal go into play. So what are your thoughts on valuations now? And are you seeing valuations in the growthier areas? Are they attractive now to you?
Yeah, so in our macro model, the Berman's called Pro Eyes series, so you can Google Pro Eyes and find it on the internet. There's a 20-factor model, and out of the 20 factors, 4 of them are valuation. And it's a statistical exercise that, when valuation gets extreme, you see the red lines. So, going back to 2016, 2017, we first started to get these more extreme valuations. And for me, it's a problem as a value tilt investor or growth at a reasonable price. I didn't see a lot of it in many places. Very famous investor, Jeremy Grantham, had been talking about, this for years, and the excess valuations. So, but valuations are not a good timing tool. So that's why in our model of 20, it's got a weighting of 4. And you look at the traditional forward PEs, you look at equity risk premiums, there's a number of different ways to look at price to sales and so forth. And valuations have improved, not quite to the levels where they're green, risk on, great value like we saw, at the depths of COVID. But have cooled from the higher levels of the last year and a half or two, as you can see there. So valuations have improved. Equity risk premiums have got a little bit better as interest rates have started to rise. So that's a small positive. Again, as a timing indicator, it's not a great tool. It tells you about, what are your expected returns likely to be for the next few years. Right? So when valuations are extreme like they were, 4, 5, 6, 7, 8 months ago, and we were in the red, the forward-based average returns come down. So right now, forward-based average returns are probably going to be around average. So what does that mean for global equities? We can expect somewhere between 6, 7, 8% on average for the next 10 years. When we were up in the red zone, that average return is around 3-4% range. So that just gives you a forward-looking metric.
They're really interesting. And I just wanted to show the audience members, I pulled these. These are as of the end of April, these returns. They're just monthly returns, but just kind of a visual of what valuations or how returns have really pulled back year to date. Something like the NASDAQ down almost 20% year to date. So, valuations really, really pulling back, equity markets pulling back, but especially those growthier ones. We haven't seen returns like this in a long, long time.
Well, you look at Canada though, Danielle, maybe you go back there for a second and say, well, is the Canadian economy doing that much better? No, it's all about the sectors and the weightings. So NASDAQ, obviously big tech, long duration in an inflationary environment does very poorly, where Canada has got a lot of commodities in it, and in an inflationary environment does very, very well, even though slightly negative on a year-to-date basis, outperforming most of the world. But if you looked at this on a 10-year basis, so return since inception. So I'm not sure how far back that is, but you can see how Canada has underperformed the US markets with its much more growthier focus, but outperformed international developed markets, the EFI markets, because Europe, Japan, I mean, they've been struggling for any type of growth at all. And the bank weighting in Canada alone accounts for that big difference compared to the negative interest rates we've had for the past decade in Europe.
Yeah, great point there. And that's what we do often talk about when you're adding regional exposures, whether it's the S&P 500 or broad Canadian equity ETF. Understand those sector breakdowns, because every region looks a lot different from a sector perspective, and that will definitely drive the underlying return. So great example here. Thanks for pointing that out, Larry. So another big topic we talk about a lot, Larry, is currency. And this kind of even just ties back to our opening question or opening chat about benefits of ETFs. So Canadian investors with ETFs can manage the currency exposures in their portfolio. They can access unhedged, hedged, or US dollar ETFs. So what are your thoughts on managing currency in portfolios, and how are you seeing, CAD USD right now?
Yeah, maybe you can go back to that first slide where we had the difference between ZUE and ZSP over a decade here. The underperformance of ZUE, the hedge version, is really speaking to what the currency difference is between those. So ZUE is being a hedged exposure to the S&P 500 and ZSP being unhedged. So, that ratio of 0.75 currently, or 0.725, tells you there's been about 27.5% currency impact over that long period. So going back to the Canadian dollar slide, if we can for a minute, I look out, 6 months, 12 months, 3 months, sometime in the not too distant future, and say, well, what is my expectation of where the Canadian dollar is, one, fair value, and two, should trade? And that for me defines, am I in ZUE when I want my S&P 500 exposure, or am I in ZSP? And so key things here for the viewers: what's your time frame? What are your trading costs, right? This is different than having to buy something in US dollars, being charged a currency charge in your discount account for doing that trade back and forth, right? So this is a way to keep it in Canadian dollars in a registered account, not have the the currency impact of buying and selling foreign currencies. Makes it very, very efficient to take a currency view. So I did a study years ago. We went back to the breaking of the Bretton Woods Agreement in the early 1970s, and we tracked the Canadian dollar relative to the euro, relative to, well, the euro wasn't there, but the Deutschmark at the time, relative to the US dollar. And we found that on average, the currency impact, Canada-US, could be as much as 500 basis points a year, and internationally, almost as much as 1,000 basis points a year. So having a view of the currency, which most people don't at all, is actually one of the biggest sources of returns. So I think ETFs, having hedged and unhedged currency exposures. Here's your Euro CAD chart going back to the early 1990s here. And the euro actually started in 1999, but this would be the synthetic euro, or basically the Deutschmark and the franc weighted currencies. So you can see right now, it's actually advantageous to have that foreign currency exposure. When this was at 160, a year ago, 2 years ago, it wasn't as attractive. Now, it doesn't mean we're going to go back to 190. It doesn't mean we're going to go to 120. You have to make those judgments about what's the Canadian dollar value relative to exposure to Europe, and as to which ETFs you're going to hold. So when one of my favorite dividend exposures is ZWP or ZWE, and these are exposures to great dividend paying stocks in Europe. And so my risk is the British pound, and my risk is the euro, and my risk is the Swiss franc, and my risk is the Swedish krona, etc. So, you look at those currencies and do you want them hedged or non-hedged? And right now, I'm tilting towards not hedging the currency.
Right. So good point there at the end. So when you're thinking about currency exposure or not, if you're taking on that currency exposure, it can provide extra returns to your equity return, but it also can provide a little more volatility. So if you think about hedging that currency exposure away, you're hedging away a little bit of volatility there. So a couple considerations to consider when you're currency hedging or unhedging within a portfolio. Another hot topic that we've had this year in terms of investment strategies has been dividend investing. So Larry, this is another investing strategy that we saw was out of favor in 2020, 2021. Now it's rolled into favor and is actually outperforming many other areas of the market. In fact, most other areas of the market. What are your thoughts on dividend paying companies right now and dividend strategies in this environment?
Well, you roll the clock back, and this is year to date. And you look at what was the biggest holding in the TSX, at the start of the year, and I'm betting at Shopify. It's no longer the biggest weight, and it was huge. And that stock's been cut in half or more. And so, if you look at the attribution and the differences, it's not so much that the dividend payers have done well; they have. But it's because a lot of other companies have done poorly. So it's a combination of both. When we look at the forward markets in the US of dividend paying, the expectations are that dividends start to fall off in the next couple of years. There's a futures market that says, what is the dividend going to be on the index? And you can trade that change in dividend if you were so inclined to do that. And when you look at those forward-based markets, it's telling the dividends coming down. What that tells me, Danielle, is that margin pressures are coming, and the market is sensing a bit of a recession where some companies may be cutting dividends. So, I think the way BMO sources dividends into their ETFs, sustainability of dividends, it's really important. It's not good enough just to look at what it paid last year and say, I'm going to earn that going forward. And maybe you have some comments on that.
Yeah, Larry, exactly. We say that a lot. There's a lot of investors out there who like to dividend invest. Some of them do the stock picking side. We always talk about the ETF as being a great approach to getting access to a basket of dividend paying companies. But we always remind our audience, do your research. What are what companies are you investing in? If they're paying a dividend today, will they be able to pay that dividend tomorrow? Will they be able to grow that dividend? Do they have enough cash on their balance sheets to continue to pay that dividend? Is it sustainable? So at BMO, these are all attributes we look at when putting together our dividend ETFs and these dividend portfolios that will really strengthen the portfolio in a recessionary environment when a lot of these companies start cutting and slashing dividends. So good to point out there that in harder times, a lot of these companies, their dividends might not be sustainable.
Yeah, and again, a lot of when you look at the attribution of these, so here's a chart looking at a couple of my favorite ETFs in our ZZZD ETF that we manage, and some of the exposures that we have. Again, hedged versus non-hedged. So there's a couple different ways to play those exposures, but you can see that over the past couple of years here, if you're going to a ZPAY, which writes puts and does the covered calls, you're getting a much higher yield into the portfolio than you are with just the covered call side, but you get less upside capture, right? So if we're more bullish and we're yield seeking, ZWH, or depending on whether we want the US currency exposure or not, we would go to the US version. And the same with ZPAY. And you could see actually in this snapshot that the returns are pretty similar, currency hedged or non-hedged. So, you know, from end to end, the currency didn't matter too much in this window, but generally it does have a pretty significant impact over time. But also from a directional exposure, when you want that, I want the dividend and I don't want the covered call, then you know you go right into that direct dividend exposure, in which case I probably should have added the ZDY and the ZUD as the two ways to get just the dividend exposure without the covered call. Because in a strong up market, those will tend to lag, even though you get a higher yield. They will tend to underperform a little bit in a strong up market, which is basically the last few years. When you want to be more defensive, ZPAY is a way to get more defensive. ZWH is also defensive, but not as defensive as ZPAY. So you've got to always take a forward look, and then you figure out which is the right ETF for the job based on that forward projection. Now, if you don't have confidence in that forward projection, tune in every Monday to Berman's call, and maybe I can help you with that.
Can provide some insights. Let's stick with ZPAY for a second, because Larry, I don't know if our audience knows, but you were one of the architects behind this ETF. And way back before we had it, we were in conversations with you and our portfolio managers and our product strategy team, and you had this idea for an ETF which had puts, which had some calls, which provided some exposure to US equities. Can you just talk to us a little bit about this ETF in the environment we're in right now, how it's been performing, and why you thought it was something important to bring to market for investors to access within an ETF?
Yeah, you know, you hear the stories of how many times people went bankrupt and failed before they gained some success. Steve Jobs, in other words, and I'm not equating myself to Steve Jobs at all, but the first iteration of ZPAY was combining ZPW, which was the put right ETF, with ZWH. And so you had put right strategy and ZWH covered call. And those two together gave you a certain path of returns. And it didn't play out how I expected it to in the first iteration of that. And I went to BMO and I said, hey, let's merge these two styles together. But here's what I want. I want you to find me the great companies that you actually want to own. And once they get put to us, we write a covered call on them, generate that yield, and then sell it where we want to sell it. So by putting them together is actually a better solution for investors, much more stable, low volatility. So here's an ETF that buys low, because as you're writing puts and markets go down, you get to buy stocks at better prices. When markets rally, things get called away, you sell high. You're getting 3 times plus the yield of the S&P 500 with half the volatility. And Danielle, to me, for conservative yield-seeking investors, this is a great way to get exposure to the US market. But again, in a strong up market, you're not going to get those huge returns because it's not designed to do that. You're going to get that 6% plus 2, 3, 4% maybe in a strong up year, not a whole lot more of that, whereas ZWH would obviously give you more upside.
Right, and we've seen it, in 2020 when markets crash, and now we've seen ZPAY doing exactly what it was designed to do, outperforming in these down markets, still providing that yield. And as you said, as these puts are getting called, the equity portion of the portfolio trends upward, but we're buying higher quality blue chip companies. We've done a big screen on these companies, so we know that they're companies we do want to hold in the event that the market sells off. Now, another ETF we have at BMO that actually, Larry, this is your strategy. This is your ETF, ZZZD, the Sleep at Night portfolio, BMO Tactical Dividend ETF Fund. This is the ETF series of it. So this is what you manage. The underlying holdings are all ETFs, but you actively manage it. So the portfolio tends to change over time depending what the market environment is. It has a dividend overlay, so it is have a yield target, I believe. But I was looking at the portfolio just this week, right before we got to meet and chat about it, and I'm noticing a lot of trends. So you're looking more at the international space, Europe, emerging markets. So what are you thinking? What's going on in markets right now that's leading you to this tilt in the portfolio right now?
Yeah, that's my value tilt. And we're saying where are the value stocks? Where is the dividend better and the yield better? And international markets define that. Now, up until Mr. Putin did what he did, the international markets were actually looking quite good on a relative basis. And so Europe got hit hard with the the lack of energy and the issues around that, and of course emerging markets. Some of the emerging market exposure had some Russia exposure in it, so there was a bit of a hit for that, and unforeseen kind of circumstances in that regard. So there are always risks to investing, but a lot of those, I think, when we look out 2, 3, 4, 5 years, I've tilted the vast majority of the portfolio international because I do like the exposure there. And right now, I think Canada, from that perspective, is an underweight, because I don't believe that we are going to see the TSX outperform like it has, given the energy exposure. So you can't look in the rear view mirror, Danielle, and say, well, that return was good, I want that. That was the return. You always have to be forward looking. And when I have that forward looking lens on, international makes the most sense to me. So that's kind of where things are at with us, and it could take time. Now, at the outset, I talked about some innovation in terms of protecting portfolios. You can see those tickers there, and you go, what are those, Larry? SPXW. So these are our put protection and covered call exposures that we have to the portfolio that dampen the volatility. So when we feel the risk to the downside are really high, we can put on these volatility buffers so that we really get a sleep at night effect. Historically, we would bring in fixed income to the portfolio and get that yield from the fixed income, which I would argue today, after inflation, doesn't do it for you. So, volatility dampening by way of buying puts in the portfolio and adding some covered call exposure to reduce the cost of those puts are really a great innovation to ZZZD, and I'm really excited about the addition to that.
Great. And then you shared this with us as well, Larry. Do you want to talk through this, some performance looking back?
Yeah, just on a year-to-date basis. So the white line there is the total return of ZZZD on a year-to-date basis. It's lagging the global dividend benchmark a little bit, but doing way better than the total world overall. And the lagging, you could see we were actually keeping up well once the Russian-Ukraine conflict hit. That's where the international started to diverge away from more of the North America exposure in the dividend basket, and so we've lagged a little bit because of that. But I don't expect that to continue on a go-forward basis.
Now, Larry, we're halfway through 2022. A lot has happened this year. What are your thoughts going forward? What's your outlook for the next half of 2022?
So peak inflation, we talked about a little bit earlier, Danielle. I think the markets are going to like that. We heard from one of the most hawkish Fed speakers on Friday, when the markets were cratering, literally came out, and within minutes, the market turned and ripped higher. As we sit here almost a week later, the markets are up from those extreme points. And what Mr. Bullard had said was, well, we're going to tighten up things now quickly, but in 2023 and 2024, we're going to ease. And the market really liked that, because the Fed, from that lens, isn't going to overdo it and cause a recession. So they are very, very mindful of equity market risk. The Fed put is still there. It's way harder for them to ease and to start QE again. They have to unwind the balance sheet. They've got to do these things. There's $2 trillion sitting in the repo market. There's a lot of cash that can suck up new bond supply and that shrinking of the balance sheet over the next year. I think we're going to get a market bounce here. But Danielle, we're probably heading into a stagflationary environment. Inflation's going to be stickier. I don't see new highs coming. I see a bounce, and then I see more downside potential risk if the Fed does overdo it and inflation does prove to be stickier than the Fed believes. Fed thinks it's going to go back to 2 to 3%. If it sticks at 3 to 4, money's just going to have to be tighter for longer. That's going to impact margins. We will not see equity risk premiums able to expand in that environment. So, bounce for now, maybe good for a couple of months. 43, 4,400 is the most I can see on a bounce here in the US markets. The Canadian market will underperform a little bit, I think, in that, because a lot of the bounce will be the more growthier names that have been more oversold recently. And we'll stay tuned Monday at 11 and in case I change my mind.
Great insights, Larry. Just from my perspective as an investor, I opened my first RSP and TFSA in 2008. So I've lived as an investor through some market sell-offs and some market dips and minor crashes, but each time the Fed has been able to step in and raise rates and QE and equity markets have been able to rebound. So this is the first time in my investing career, and I know many of our viewers out there who are now facing this inflationary environment and the rates going up as equity markets turning down. So I really appreciate your insights today, Larry, and all your expertise. It's been great to have you on the show.
Danielle, my first mortgage, which may have been before you were born, I don't know, but it was double digits. I'm just saying. A lot of people don't understand inflation and high interest rates. We've just been used to falling rates for a long time. Most people investing today don't know how to deal with this. So it's going to be an interesting couple of years in front of us for sure. More market volatility is almost a certainty.
Definitely, but it's great. Today we have ETFs available for investors so they can pivot, they can be tactical, they can change their exposures. They have great channels like Berman's call on YouTube and ETF Market Insights to go to get education so they can be as well prepared as possible for market environments. So I did want to highlight your channel, Larry. Wow, over 8,000 subscribers. So we'd love to get to that on ETF Market Insights. But a great resource for anyone out there would like to listen to Larry every week. Now, I do have questions. We have a few. Some came in, but we thought we addressed them over the show today. So we just kept a few in here for Larry. Larry, are there any interesting sectors or maybe even themes that an investor should look at during these volatile times, which could provide some upside or growth if you're looking out long term?
Yeah, so outside of dividends, a lot of the growth areas, robotics, artificial intelligence, new innovation, all these areas, early stage companies, they don't pay dividends. So from the dividend perspective, no, there's not a lot of new ideas. And maybe old energy right now is one of the better ones there. But new technologies, we have a thematic sleeve in our growth portfolios and our balanced portfolios. And right now I like uranium as a transitionary metal in terms of getting us to a green future. I love clean energy. ZCLN is an exposure we have. I love medical marijuana. I think it's going to be a huge part of pain management, well into the future. Right now, those stocks are dirt cheap, and the news is terrible. That's the time you need some exposure there. So we've got some of those thematics in the portfolios. I like robotics. I like artificial intelligence. I like cybersecurity. All those things in our growth and balance portfolios. Those two aren't available by way of ETF though, just our sleep at night dividend strategy. So there are two other funds we do manage for BMO that have a lot of those thematic sector exposures in those, and they are available to purchase as well.
Yeah, we talk a lot about how growth stocks have really sold off, but a lot of the underlying themes, Larry, those themes haven't gone away. These technologies are still advancing. The need for them is still there, if not greater now than before. So short-term pain for a lot of these growth stocks, but if you have a long-term outlook, a lot of these themes seem pretty strong looking out.
Yeah, a year ago, Danielle, with the valuations where they are, being a value guy, I hated them. And we just, for the first time, put some of Kathy Wood's exposure into some of our portfolios also, where, she looks out with that 5 or 10 year lens onto what the next new companies are going to be. And so, really kind of think that those valuations are interesting now, being down 60, 70% from what they were at their peaks a year ago. So a lot of these things do need to be traded. Very hard to buy and hold in early stage innovation. I would tell you that.
Yeah, a lot of volatility, bit of a roller coaster as we're seeing, as we're witnessing that all play out now.
Amazon dropped over 90% when the tech bubble burst in 2000. Nobody could have stuck with it, through the whole ride there. There's not a person with that, ability out there that I know of anyways.
Yeah, a lot of these companies take a long time for their growth thesis to play out. Last question, we kind of touched on this in the currency section, but I'll be clear. So ZSP is BMO's S&P 500 ETF. ZUE is also the S&P 500 ETF, exact same exposure. The difference is ZUE is hedged to Canadian dollars, so you're hedging away that currency exposure. ZSP has the currency exposure, the US dollar currency exposure in it. Larry, that was great. That was a lot of fun. Thanks so much for joining us. If you'd like to join us next week, ETF Market Insights, we're going to be talking about building a fixed income portfolio using ETFs. It is a pretty challenging time for fixed income investors, but the great thing about ETFs is you can be tactical in picking your exposure. So we're going to talk through that with Alfred Lee. Thanks for joining us, and we'll see you next week.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.